Hello, everyone. This is Andrew Berman for National Mortgage Professional Magazine. Thank you for joining us for another Mortgage Leadership Outlook. So excited to have you join us on this beautiful Wednesday. Hopefully it's beautiful wherever you are. It's certainly a beautiful day here in New York. And with me, I have got John Lynch, founder and CEO of PCMA Private Client Lending, a former professional surfer. John Lynch, thank you so much for joining us, John. I really, really appreciate it.
Thank you for having me, Andrew. I appreciate it as well.
Yeah, I feel like that, like days like today, like the weather we're having here is kind of like the weather you guys have all the time. This is like a cold day for you guys. What is the weather like where you guys are right now?
You guys really don't want to know. I think it's about 80 degrees and sunny, not a cloud in the sky.
It's beautiful, man. So listen, man. So like a day like today, back actually, when before you were the successful mortgage banker, before you actually started, the non-bank private client lender, which I will talk about that because I want to know what a non-bank private client lender really means. But go back to your surfing days, so you're a professional surfer, like skating with greats like Kelly Slater. Where did you actually go from there to in the mortgage business? Talk a little bit about that transformation.
So when I was young, I was born up in the LA area, and then my dad got a job down in the north part of San Diego County area. So they moved us to a small little beach town called San Clemente. And in that town, I moved there when I was about 11 or 12. And then, as I started to grow up in that area, I realized very quickly that if I want to get attention from the girls, I better learn how to surf. And so, it's a hotbed of talent down there. And so, I took my competitive nature from sports and, adapted it from, I thought I wanted to be a professional baseball player. I got introduced to the beach lifestyle, took it from there. And then day after I graduated high school, I promised my mom I would graduate high school. I turned pro and went on tour for the next 5 years.
Oh, that's awesome. So did you win competitions? Like where were you ranked? I mean, what I got to understand this because this sounds awesome. I mean, this is a dream. Like as I live in a coastal community, I spend my entire summers at the beach, and we've always look at these surfers and we're always in amazement. And you did this professionally. So talk to us a little bit about the successes you had as a surfer.
Yeah, I mean, it all starts, as an amateur. I was highly ranked as an amateur, and then when I went on tour, I started on the Bud tour at that time they called it, and that was the stepping stone tour towards the invitation only tour, which is what is the world tour today, and only the best 44 surfers in the world could be invited to that. And you're talking about the entire globe. So, I didn't get deep enough into it because as I got to around 22, 23 years old, as much fun as it was chasing girls and chasing waves, I realized I wanted something more than living out of a backpack and an airplane. So that's when I came home. I stopped surfing competitively so I could lose my professional status. Therefore, I could surf pro-ams and stuff like that for leisure and hobby and keep some of my sponsors around. But I really at that moment started to transition my competitive nature in sports into my professional career. Whatever that was, I didn't know where I was going to go or where I was going to land, but I knew that I wanted to not live in flip-flops and surf trunks anymore. And rock a suit and not look funny.
Yeah, and be number one at that. So here you are in your competitive nature, and you're doing great actually with surfing competitions, and you say, okay, I'm going to actually put a suit on, and I am actually going to take on the business world. I'm going to take on credit and take on financing. And so, what's your first job in the mortgage business?
So my first job in the mortgage business came from, I got an opportunity to get sponsored for a securities license. So I got my Series 7. I went into institutional fixed income, spent a stint there, realized I didn't want to be in the securities side of the business. But I got introduced to, my mentor was grooming me towards banking and said, let me introduce you to what banking is and how that works. And so he goes, why don't you go get a job in the mortgage business so that you can understand that side of the business, and it was all a staging towards someday running my own regional bank. But once I got into the mortgage business, it just kind of stuck. And, that was January 10th, 1996. And then and then in August of 97, I started my own company with a friend of mine. We were focused in the subordinate lien space. And then from August 1997 to August of 2006, we grew it from just him and I to the largest privately held home equity line of credit lender in the country. And we were being acquired by Capital One at the time.
That's fantastic. So like, where was the point actually where it hit you, where you realized, okay, I found actually what I want to do, for the rest of my life. I found that calling where you felt so connected to it. And listen, I understand you're an entrepreneur, you've got several businesses, but clearly it seems that this is actually, the thing that you're most passionate about. So when was that? When did you find that passion?
Well, I correlate it to this a lot of times. There's a lot of people in the business. It's an enormous industry, but it's a small community. And there's a special few, the real strong, the Mazzillos, the Stearnses, the guys who build great, they have an instinct for the business. I call it, they can see the matrix. And you can, my staff will never build my company the way that I would build it, because they don't see it from the periscope at which I see things. And a lot of it's instinct, but a lot of it is just it's an intuitiveness to the business, right?
Yeah.
And so, and then also on the other, it just stuck with me. My mentor goes, John, if you want to get rich, sell money. I said, great. Where do I go? He said, go there. And I go, great. I'm going to be in the mortgage business, and it seems to work.
Yes, I love it. That's awesome. That's great, man. So you got into the business. You found actually, your calling. So talk to us about, when you started working with, the high net worth clients. And I want to know, like, how did you find actually that as a niche? And, there's a lot of actually our audience are going to be watching this saying, listen, I'd love to be able to work with high net worth clients. So give us a little bit of guidance of how you started working with them, and if you can give some tips on how our viewers can start working with high net worth clients themselves.
Sure. The first thing that starts with is you have to identify who you are and what you are in the market, so that you have clarity on so you have clarity for yourself and your team, and then you have clarity and message out to the community that it is you're trying to serve. Yeah. So for me, my previous company, it was very clear for me. I wasn't even in the mortgage business. I was in the HELOC business, right? For the first 6 years, I thought I was in the mortgage business until, we did a branding exercise and we identified that, our tagline was the home equity specialist. And I could clearly see what my business focus needed to be and what parts of it no longer were relevant. So niches to riches is the saying. So then our firm was always, we were growing towards the private client community through jumbo lending, but I was invited to be a part of an advisory council that met occasionally to talk with the CFPB about regulations they were thinking about changing. They wanted to know what kind of unintended consequences it would get and get feedback. And I remember I was at this conference with the MBA. The economic team for the MBA was up there talking about agency stuff, and they showed two slides. A 2003 to 2007 slide, and fast forward 10 years, 13 to 17. The average loan volume per year between 03 and 07, 2.8 trillion a year. 2013 to 17, 1.7 trillion a year. And I asked myself, I looked at it, I started doing the math, and then they kept talking, and I finally go, hey, can we talk about the elephant in the room? In the lowest interest rate environment in history, where did $1 trillion of annual loan volume go? And so I immediately, we weren't there to talk about that. We were there to talk about agency stuff. But I immediately started doing my homework, and then I put two and two together. Prior to 2008, the client and community we serve today, that mass affluent and high net worth, they used to be absorbed by the depositories on their jumbo portfolio programs, and due to regulations and stringent ATR requirements, they pushed out the business owners, the high end, the business owners, the investors and the asset-rich retirees. And so they always say niches to riches. A lot of times the niches aren't scalable. I would say $1 trillion a year of volume is an enormous opportunity. So then I went further, and this is really important for your viewers.
Okay.
32% of all U.S. households would be classified as mass affluent and high net worth, yet only 3% are in managed money accounts. So what that means is they have enough liquidity that the private banks and the wealth managers would manage their money, 3, 5, 10 million of liquidity or investable assets on up. And therefore, if you needed any financing regarding property purchase or investment purchase or whatever, I mean, it's a sign and drive, we'll collateralize some assets, whatever. But the guy that we serve today is not the guy that's reached liquidity yet. He owns 6 Jiffy Lubes worth $20 million. He lives in a $4 million house, owes $1.5 million on it, 55 to 60 years old. Kids are going off to college. He has a big house. He's accumulated equity. He's got a $20 million oil empire, and he might only have $500,000 of liquidity. That $500,000 of liquidity will not even get a call back from Chase Private Client or from Morgan Stanley or anybody else. But in a few years, he's going to move from wealth accumulation to wealth preservation. And then all of a sudden he's going to have, I know how to run a $20 million oil empire, but I don't know how to manage $20 million bucks. Mm-hmm. So before he moves into wealth preservation and liquidity for wealth management, we come in and we do leverage management and start prepping them for that. We step in there where the banks don't operate. Think about the gap they're in. The very bank that I used to have my loan with won't make me a loan on the home, and the very bank with their private client won't even pick up the phone to help me manage and financial plan. And they're the highest credit worthy borrowers. So here's the point. 30% of all U.S. households are stuck in this gap.
That's amazing. Yep. So they should have these products. Common sense actually would say that loans should be made to these people because yes, okay, maybe their AGI is pretty low, but they know exactly actually how to manage their business, and they're not missing their mortgage payments.
They've been a homeowner for 3 decades. They've been managing credit for 4 decades. They have successful business. They've accumulated equity in there. It takes a while to accumulate 40, 50% equity. So, at the end of the day, you take 30% of the credit out of the entire housing credit pool, and they're the upper echelon that helps support the totality. You take the best of them and you put them away. You take them out of the pool. Yeah. That doesn't bode well for us. Plus, you have a dislocation. We don't have a housing issue from not building enough housing. We have an inventory issue. Well, where's the inventory issue come from? Well, you just took 30% of all U.S. housing out of the ability to bring their houses forward into the market to balance that supply chain. That's demand supply dislocation. So you have this real unhealthy price appreciation because you have the most credit worthy and houses that are not coming to market sitting on the sidelines. And those are the rights of unintended consequences through regulations that we at PCMA are trying to resolve.
Well, listen, it's great actually that you are actually involved in the dialogue with the CFPB because they need to understand actually, the negative impact of this. So your solution basically has been to use non-QM products and other actually products that you guys have access to and offer them part of your non-bank private client lender. So you guys are a non-bank private client lender. So can you tell us actually, if let's say if you were an originator, if you're one of your originators that is at PCMA and you're a non-bank private client lender and you have that opportunity to give that elevator pitch, how does that go from an originator perspective? Not necessarily John Lynch, founder and CEO, but an originator on the street. How do they say it actually in an elevator pitch?
Well, the first thing is to stop being a mortgage broker, because the reality of it is the mortgage broker has failed in their eyes, they've failed them for the last 14 years. Obama said I can get a mod, failed. Don't be a dummy, save the money. They called cash call, wouldn't do me because I was self-employed or whatever. And so, these people have never been denied for credit in their entire life, right? Yeah. So, and the last 3 times I've tried to refinance, because everybody tells me it's a great time to refinance because rates are down. After the 3rd time of getting denied, I'm out. I'll just pay cash for my house, right? And so there's so much distrust in the marketplace. Sellers won't accept contingent mortgage offers if there's an all cash offer on the table as well. Why won't a seller accept that? Because they don't trust the loan actually getting through and not causing escrow problems. So you have all this distrust built into the deals. So, and no matter what, the mortgage broker has been tarred and feathered that they're the face of all of the financial crisis. So now what they need to do is recognize that, the mortgage broker, the mortgage process is a dreadful experience. The mortgage brokers have been tarred and feathered as you can't trust them. So at the end of the day, understand, you don't sell mortgage products. You serve a community of people who have this situation. You need to level up. You need to reposition yourself to speak in their language and understand the complexities of their needs, and then get comfortable in that new role. We basically say, look, we're not in the mortgage business. We're financiers of private client and private client experiences. Fantastic.
And you feel like that right now we have a $1 trillion worth of opportunity that's not being, that's what you'd say the market is.
Well, for sure. And I mean, you just go and I don't know the actual figures, but just on the buy side of real estate, the amount of all cash transactions at time of settlement is astounding. I mean, on an annual basis, that's in the hundreds of billions of dollars. And so, and then and how many homes are not coming to market? Redfin came out with their white paper, I think it was in January, saying the average turnover nationally for a house, it was 7 to 8 years. Now it's 13 and rising. Why is that? Because the guys who have been shut, you can't sell cars without car loans. If 30% of your housing market does not believe that they can buy a new home because I can't refinance the one I'm in, they're just going to sit. So it affects the real estate industry. It affects the local economy because movers aren't moving people. Painters are not painting houses. It just creates this ripple effect. So it's not just like, hey, so what? Rich people don't get home loans.
No,
it affects the whole chain, all the move up, all the move out, all of it.
Yep. Yeah, I get the impact. So you basically, you have through your organization, you've created the opportunity to allow mortgage brokers to basically go through a transformation. I mean, that's what it really sounds like, because it's basically saying don't be a mortgage broker, and give me so if I am a mortgage broker, and I'm call myself a mortgage broker. I do a little work with some high net worth clients, but I want actually to become actually a non-bank private client lender. What would be the process as me being a mortgage broker and working with PCMA?
Well, the first thing is this: it's not that you don't be a mortgage professional, but the consumer, you're fighting against this embedded distrust for it. So the only way that you're going to get the attention of the clients that you're going to serve is you have to get them to believe that you know them and that you're 100% committed to them. You're a specialist in your space. Mortgage brokers aren't good at anything because they don't specialize in anything.
Yeah.
Right? I'm a mortgage broker. I do a reverse when I don't know how to. I'll do this, I'll do that. Because when you're an independent mortgage broker, you'll do any loan that you can because you're just trying to run your business. But the best way to grow your business is specialize in a category.
Yeah. Yeah. Stay in a lane.
And stay on message so that you know what you need to do internally and where you live. And then in return, you don't create brand confusion and capability confusion.
All right. So John, let's say actually you see the show actually Undercover Billionaire?
Yeah, I know Glenn very well.
Okay, so let's say actually, John, we're doing something similar to you. We're sticking you actually in a high net worth community. We're putting you actually a place actually, it's going to be in the Hamptons. Let's call it in the Hamptons out here on Long Island. You have to change your name, put a disguise on, so people actually won't know you. You'll have no contacts. How do you build a book of business? From scratch, helicoptered in. No contacts, can't use anything.
By the way, I love that analogy. I mean, the reality of it is the best way to get the attention of the affluent is to honor their accomplishments, celebrate the aspirational, inspirational, and the accomplishments of that community through your marketing. And that's how you get their attention, because they demand experiences more than they demand products or services. And if you speak their language and you do it, you create an experiential luxury service or message and an emotional connection to you as a brand, the rest of it will fill in, because it's just, in time you'll walk into a room and you won't even, you'll have this just unbounded energy like I belong here. But in the beginning, put it more up on just the marketing of I understand you, I celebrate you, show them on fancy yachts and different things like that, but don't be fake.
Yeah.
And then narrow your focus to the products that they're going to need in order to serve that community. And get good at that.
I love it, because listen, you instantly actually show a common bond with someone by showing actually an appreciation for them and their accomplishments. That's their favorite thing is their accomplishment. They're proud of their accomplishments. You basically show your admiration for those accomplishments and celebrate it. I love it. That's a great approach. So all right, so we're going to shift gears, because I want to talk a little bit about PCMA. So you guys are very successful. You've got some great growth. So you guys are only working 9 to 5. You're in the mortgage business. You guys actually went through 2020, and you're going to really tell me actually that at 9 to 5, so no one works before 9, no one leaves, no one actually stays actually and continues working after 5 in 2020.
Our hours of operations are actually 8:30 to 5:30. We do have staff that comes in at 7:30, but they're out at 4:30. We're a 40-hour a week organization. Those are professional hours. First of all, I've seen extended hour operations, and I've never seen the increased productivity. It all goes back to, hey, if I've got 8 hours of work to do and I only have 2 hours to do it before I go on vacation, I get it done with a half hour to spare. Give me 2 hours of work to do in an 8-hour period, I don't get any of it done. So the focus and attention is that I've not seen the productivity return for the pressure that it puts on work-life balance.
Yeah.
Right. Like I've seen these extended hour operation platforms around me, and it's fun in the beginning. It's a rush to work like Saturdays, but for months and months and months, it affects them not only professionally, but personally. And then in addition to that, as a professional organization, I hate when people call my place a shop, because we're not a shop. Like, we're a professional firm. And then in addition to that, we operate professional hours. So yeah, I don't think it's professional to be speaking to a client at 7:00 when it's during his family time.
Listen, something, we had someone actually as a guest on Mortgage Leadership Outlook, Eric Mitchell. He had said this, do you want to be always available, or do you want to be worth waiting for? Right. And it makes all the sense in the world. Actually, I love it, and especially when you're working with high net worth clients. They like things that are predictable, and sometimes maybe you're going to be available at Sunday at 8:00 if they call you. Some days you're not, because you're doing stuff with your family. They'll want actually predictability, because they're running their business. They don't have the time, but if they could schedule it and know actually that you're going to be there 9 to 5, it works.
I can't call my private banker at Wells Fargo at 6:00 on a Thursday night.
Yep. Yep. Totally. I understand completely. So, all right. So listen, I'm going to, one thing I want to wrap up with. So, you've gone through 2020, actually, as far as the capital markets, the melee that we saw, and I want to get your feeling about the future for the jumbo market and the appetite of the capital markets.
So there's two components of the jumbo market. So obviously, prime jumbo is correlated to the interest rate cycles that typical agency stuff is correlated to. When you get into non-correlated rate products, where we're bound by credit spreads and different things, like the stability of our coupons and stuff, we don't we don't have midday activity and different things like that. We're based on, swap trades and different things like that. That's what we're correlated to. So as interest rates move up in the mortgage space, that will definitely create a move towards like, hey, clearly there's no benefit in the agency trade anymore. How do I move into the jumbo space and go help me untap the $1 trillion a year of activity? I see I've been begging for interest rates to go up so that our community, no one knows in our community that it's a great time to refinance until you have hundreds of millions of dollars a week spent in advertising saying rates are down, great time to refinance. This community of $1 trillion of volume that's not in the market today, I'm only one company. There's 330 million people in this country. We need to get out that same message so that we could start to rebuild that trust in the market again, thaw the iceberg one drop at a time, and start to get that liquidity moving in. And the nice thing about it is our average loan amount's almost $1.5 million. So, it's a lot less brain damage, and you'd rather sell a $500,000 condo or a $5 million condo in New York, right?
Yeah. So great. So you're just hoping actually that the capital markets continue to grow that thirst for actually.
Oh, no. Let me tell you, there is an enormous amount of liquidity, unlike anything I've ever seen. We are not creating enough mortgage-backed securities for the investor appetite by 13, 14, 15 to 1.
Are you serious? So the huge opportunity right now. So right now we have people ready to throw money at us. We're just doing a crappy job of talking to the high net worth borrowers about actually this opportunity.
We do not have attention in the community to build and produce enough assets from that credit class to satisfy the appetite for the capital market investor community.
That's great.
They are stressed out. They are freaked out because what's worse than earning a negative return on your money? Dead money, not even in the market, trying to get yield. So they're stressing for assets, and every asset I produce, it's oversubscribed at least 10 to 1.
Oh my goodness, it's awesome. That's fantastic. That's great. So tons of demand out there. We just got to get started. I love actually though you have the path actually to get started. So John, really appreciate you spending the time with us. You basically we understood actually how you went actually from surfing into the mortgage business. We talked a little bit about actually what the opportunity, what exists, this $1 trillion gap that we're not addressing, and you gave actually our audience ways that they're going to be able to capture this stuff and capture this business. So appreciate the time, John.
I appreciate you, Andrew. Thank you very much for the opportunity.
All right. And everyone, thank you again for watching another Mortgage Leadership Outlook, where we come to you live every Wednesday, 1 o'clock Pacific time, 4 o'clock East Coast time. Super excited to see you again next week, and have a great week.